as we normally do on this program, we try to make concepts in the personal finance space and the mutual fund space easy for you to understand. And one of these concepts is, if you are going to invest in a mutual fund scheme, you will probably have seen two options. One is growth and one is IDCW. And IDCW essentially stands for income distribution come wealth capital withdrawal. Okay, so income distribution come capital withdrawal. Let's go through what these two means. The growth option, when you consider investing, essentially reinvests anything that emerges from the underlying. So for example, if you're investing in a mutual fund scheme that invests in State Bank of India, and State Bank of India gives a dividend in any given year, that dividend gets reinvested into whatever scheme the mutual fund fund manager is choosing to invest in. The IDCW, on the other hand, will distribute income to you on an ongoing basis. Now, do bear in mind that there is no guarantee that this will take place on the 1st of April or any other date that is predefined. It could be if a fund manager decides at the end of the year that there is a substantial amount of gain, they could decide to give you a dividend. Now, because it's not predictable, that is something that you have to bear in mind. You're not going to be able to judge your cash flows based on what you get from the IDCW option. And the second aspect is, for a lot of people, this is not going to be tax efficient. Now, understand this. When dividends are given to you from the IDCW option, it is going to be treated as dividend in your hands, and so it's going to be taxable in your hands, but it's going to be taxable at the slab rate. Irrespective of whether you invest in equity or fixed income, it's going to be taxed at slab rate. So take an example, you invest in an equity mutual fund scheme, you choose the IDCW option. Ordinarily, long-term capital gains tax would have come to 12.5%. In this case, if you get a dividend distribution through IDCW, it would be taxed at slab rate. If you're in the top tax bracket, you would be taxed at 30%. Now, it is beneficial to you if you get a dividend and you are within 12 lakhs and opting for the new tax regime, but that's not a lot of cases, and remember that it's not predictable. If you're looking for regular payouts or regular income from your mutual fund investments, a better option to consider and a more tax efficient option to consider is the systematic withdrawal plan.